When we do analysis, we look at price patterns, we look at volumes, we look at momentum, volatility, and we look for sentiment. Now, there are different indicators that we use to identify each of these parameters. And the more number of parameters we analyze and that fit into our analysis, trading that particular script becomes much easier. So if any of these factors lack in a particular script, in a particular trend, then your trade may not be a fully high rated trade, a trade. So there may be something lacking in that. So when you have a good trade, you need to have a good price action with volumes, you need a good sentiment, you need good momentum, you need a very strong trend, and you need good volatility in that. So now when we say RSI is a momentum indicator. So now what we are going to do today is look at Bollinger Bands. Bollinger Bands is a volatility indicator. So what is Bollinger Band? Bollinger Band is a measure of volatility over time of an instrument using a formulaic method developed by John Bollinger in 1983. So this indicator is named after John Bollinger himself. And it's a very mathematically developed indicator which measures volatility. Now, Bollinger Band study includes the bandwidth, the BB squeeze, BB expansion, walk on the band, by Bollinger Band divergence, that is double top and bottom. There are two patterns, that is M and W, and then you can club it with RSI for further confirmation and trades. So we are not going to cover all of these today because it's a very long topic. We'll cover as many of them possible, and we'll continue over the next weekend for the rest of it. Now, this is how a typical Bollinger Band looks on your screen. I've removed the prices. So you have three lines that move in tandem. The center line is nothing but the simple 20-day simple moving average. 20-day simple moving average is widely considered as the best moving average with really high success rate in terms of showing the change of trend or showing the change of trend of momentum. And the bands which are on top and bottom, the two bands are nothing but the standard deviations, which are typically 2 standard deviations away from the simple moving average. Now, the calculation of the standard deviations is based on the calculation of simple moving average of 20, and that cannot be changed. So we cannot take exponential or any other average over here. Now, this is a very default calculation of standard deviations set by any system. Depending on the time frame, if one wants to change, depending on the length of the time frame, they can make it a 50-day average along with a 2.1 to 2.2 standard deviation. Now, these are calculations which one would want to try changing at their end and see how it works. But typically, the default settings work the best. Now, how do we use Bollinger Bands? Is simple. When I said that there's a Bollinger Band squeeze, there's a Bollinger Band expansion, the price itself moves in between the band. Now, this band range which is there, 95% of the price momentum data is captured between these two bands itself. It rarely happens that the price goes outside the band. It does go outside the band, but 95% of it is captured in between the band itself. How many people use it is basically to also look at it as, how whether it is trending. Let's say someone is seeing the price over here falling. It takes support of the lower band. He will look for reversal signs from here to buy. The 20-day average may act as a resistance, which is also the first target for him. He will look at it hitting the second target, that is hitting the upper band. Likewise, whenever the price hits the upper band, one would want to sell and watch out for reversal signs for it to take support at the 20-day average as a first target and the second target at the tip of the lower band. Now, that is one way how people use Bollinger Band. Second is the squeeze. Squeeze is nothing but the confluences of averages that we had seen last time. How a price starts moving in a very narrow range and the band gets narrower, which only means there is practically low or nil volatility. So when the band is narrowing, It only signifies that the volatility in the particular stock is very low. And when the band opens up, it shows that the volatility is increasing in the stock. When a volatility is increasing is the time when the stock is trending. And that is what we really need to trade. So the best way to use a Bollinger Band is to identify squeezes in the band and wait for a price action to confirm. You wait for the bands to open up and expand to show you a change of trend, and you can write the rally from there. So we'll go ahead and look at each of these with examples. This is Nifty. This is a band squeeze. You see the band is squeezing, the price is very narrow movement in between the upper and the lower band. And then there's one day when the entire band opens up, it is expanding, the range expands, and the stock starts trending up. So these kind of confluences, what we had seen on moving averages, can also be seen on the Bollinger Band. And these squeezes are something that we can watch out for and put them on the watch list, and we can look for reversals of trends in them. The same chart I have put with moving averages just to show you that if you're not using Bollinger Bands, how you can use the moving averages itself, the confluences, which shows that the stock is consolidating. And when the stock moves, the Bollinger Band shows a change of trend reversal by expansion. Even your moving averages open up along with that. This is another example where Reliance Industries on a monthly chart had seen a band squeeze for almost good about 8 years. And after 8 years, the band opened up and there was a very substantial rally in the stock. Now, a lot of people also use the trend of the band itself to identify that the band is going up, the trend is going up, the band is sloping down, the trend is sloping down, which is very typical to what we see with our moving averages also. So the direction of the band itself shows you also the direction of the trend. So band squeezes also often give a false breakdown. It is a very common phenomena in Bollinger Band that after a squeeze, without the bands opening up, see, look at here, the bands have not opened up. It is only the lower band which is turned down, and it gives you a false breakdown signifying a downtrend, but that fails and the price recovers and starts moving back up to form a new bullish trend. So this is a very common phenomena in a Bollinger Band, and it is also very helpful because it helps you identify fake breakdowns or breakouts. If there was a confirmed breakout right after the squeeze here itself, there were high chances that both the bands would have opened up. Like here, if you see a minor squeeze and then the band opens up, the top goes up and the bottom is going down, it is a confirmation, or not a confirmation, but more of a signal of change of trend, which lacks over here. If you see over here, it was only the lower one which had gone down and the upper one continues to be flat. So Bollinger Band also helps you identify a fake breakout or a breakdown. Now, range expansion. After a breakout, when the range expansion happens, once the price starts moving along with the upper band, the trend is continuing. And every time the price hits the upper band, that is called a price tag. So the price would typically move between the moving average and the upper band. And whenever it tries to walk along with the band, it is called walk on the band when it's on the upper band, and walk down the band, which is when it is on the lower band. So when the range expansion happens, the trend continues. One can continue riding the rally up. A lot of people also would like to look at signals to go book profit in the trends whenever the price tries to hit the band tags or walk on the trend, but that is best avoidable without any confirmation on it. So it is best to go with the expansion and the trend instead of looking for exit signals right at the tag points. Now, walk on the band is another way people use it to trade. And I know we still have a lot of day traders with us, in spite of us telling not to do day trading. But the backbenchers who love the day trading, this is a beautiful tool to use on a 15 minutes chart to do day trading, or a BTST or a STBT. Now, how do you use it is very simple. Whenever there's a walk on the band, that is the price is moving above, outside the band, on the first candle, you can initiate a trade above that. And as long as the candle is closing outside the band, you can continue to hold your trade. You trigger your stop loss when the candle closes inside the band. And this is best doable in the last 1 hour of the day. Whichever stock or index you see a candle that is walking the band, that is closing outside the band, you can take a long or short position depending on where it is. And if the price is closing towards the high or low of the day, you can take that as a buy today, sell tomorrow, and close your positions in the first 1 hour of opening, or sell today and buy tomorrow and close it in the first 1 hour of opening the next day. So, but it is very important that you buy only after one candle has closed outside the band, like in this case, and subsequent candles continue to close outside the band. This is very important for day traders or the STBT, BTSC traders. And it is best doable on a 15-minute chart. You see such movements on a daily and other charts as well, but obviously that is not for day trading. Day traders will get multiple opportunities trying to follow this particular pattern. This is a case of Cummins India, where it closed and the range expansion happened after a squeeze. The candle closed outside the upper band and the rally continued for 1, 2, 3, 4, 5, 6 candles. You could have booked your profit over here. Now look at it, it did break out over here, but it failed in the next candle. So this was a breakout candle. You obviously have to do it. Take a position after the second candle closes outside the band. So here it has clearly failed. Now another thing which is very, very important in this is if your stop loss gets triggered here, and let's say following a few candles later, it breaks out again. Do you again take position in that? It is highly suggested not to do that. If your stop loss is triggered, leave that script, look for another one. Don't jump into the same script on the same day, trying to do another trade in it. Now, this is Nifty. This is the walk down the band where you see Nifty closes below the lower band and the trend continues. Here, briefly, it just closed at the band. That is the band tag, and the trade continued down. This is where you trigger your stop loss. Now, these kind of trends can continue for 2 days also. So that is why it is just not intraday, but it can go on for 2 days. Likewise here, it breaks out, the range opens up, the first candle closes outside, you take trade on the second candle, you have your third, fourth, fifth candle. Now, this is a classic example where the price closed at the high of the day, plus it also closed outside the band. So typically anyone would have taken this as a BTST trade, expecting the rally to continue the next day also, which happens in most of the cases. This was one of the case where it opens gap down. So you have to trigger your stop loss here. You have no reason to hold on further to it. This is another example of walk on the band. This is Coforge. This is again 15-minute chart. The first candle, this candle closes at the band. This one closes above the band, and then you can ride the whole rally up. And this is opening on the next day. This was someone who would have taken this position, held on to the next day. Next day of the first 45 minutes, the price continued being up because this is a 15-minute candle. And then you trigger your stop loss when it closes below the upper band. This is another example of walking down the band for short sellers. It's likewise, it closes below the band and you can go short over here and you can ride the rally short down and cover up once it closes above the lower band. So inside and outside the band, usually on a 15 minutes, take positions when candle is outside the band and remains outside the band. Exit when candle closes inside the band. Do intraday or BTST, STBT depending on the way it is closing on that particular day. Now, Bollinger Bands are also used to identify two very important patterns that are called the W and M. W pattern typically happens when the rally, the fall is getting completed in a particular stock or a index, and M pattern is usually at the top of the rally. So W pattern helps us buy a particular stock at lower levels after a confirmation. Likewise, the M pattern helps us exit a particular stock and maybe even go short at the peak of the rally. So double top or a double bottom in Bollinger Band is when one candle is outside the band and the second candle is inside. Now this is a double top. Double top can also happen along with an M or a W or M pattern, and a double bottom can happen with a W pattern. I will show you these examples going forward. The low of second candle is usually relatively low and may not be the absolute low. The first candle may not be outside, but can also be touching the band. Now, these rules sound very vague when you read it, but we'll see on the charts for more clarity. Now, this is an example of double top. Now, double top in Bollinger Band may not be an absolute double top. The price of the following candle can be higher also. It can be a spike up or a spike down also. What is important is the first candle, the high has to be outside the band. And the second candle high has to be inside the band. Now, this is considered as a double top. Normal double tops is where the prices are more or less the same. We are not looking at Bollinger Bands over there. And then it gives you a confirmation candle to exit. In Bollinger Band, it is very important that the first candle either closes or tests the band or closes outside. And the second one is inside. The second candle high can be higher than the first one. That is ignorable. This is considered as a double top. They are triple tops also. So triple top in all these conditions, the first one, that first candle has to be outside the band. The second one has to be inside the band. And then the third one can be at the band. Sorry, this is also M pattern formation. This is a confirmation of change of trend from a bullish to a bearish. And based on the confirmation of this, one can book profits in the trade and maybe go short. Now, this is a double bottom, like we saw the double top. Now here, two consecutive candles have to make a low. Normally, the lows are very similar, but in Bollinger Bands, the first candle has to be outside the band and subsequent candles have to be inside the band and then reverse. So in Bollinger Band, the double top and double bottom, the first candle closing outside is very important. The W and M pattern. M pattern usually happens at the peak of the rally, clubbed with the head and shoulder. Head and shoulder pattern is very easily identifiable. So using head and shoulder along with Bollinger Band helps in confirmation. When we say M and W pattern, the W pattern happens at the fall, at the bottom of the fall, and it is a sign of reversal. W patterns are very easily identifiable. Mind you, the M pattern is not easily identifiable as a W pattern, and the price, volume, momentum, volatility is very different in an M versus the W. So W is much easily identifiable and much easily tradable versus the M. Now, this is an example of M. You have a rally, a small fall, again peaks up and then falls. So M patterns are easily identifiable on this particular case, but not always. You will see many M patterns being formed in the middle, and we usually would not be able to identify it so easily until the change of trend had actually taken place. This is W. So change of trend is very easily identifiable along when clubbed with Bollinger Band. And look at, you see a close at the lower band and a close inside. This is also a double bottom. So this is what I wanted to discuss about Bollinger Bands. Bollinger Bands along with RSI, we'll take it up in detail in the next session, because that is a little more detailed session of two indicators working together. So I will take it a little more comprehensive.